All right, good evening, ladies and gentlemen. Welcome back to episode 6 of the Australian Gold Weekly Review. I'm your host, Ved Shah, and this is a series where we unpack the market's weekly moves for gold, silver, oil, as well as the precious metals and mining equities market. Unfortunately for today, Mr. Brian won't be joining us as he's been busy this week in Perth having mine site visits, visiting the Perth Mint, and also offices of several mining companies. However, we do have a special treat for you this session to fill in for Mr. Brian, and that is an interview with the Executive Technical Director and CEO of Ramelius Resources, Mr. Daniel Tuffin. Ramelius Resources is a company that operates in the Leonora region in Western Australia, and they've recently announced a $2.1 million placement to take forward their mining operations in their Crawford project, which so far is financially and operationally doing wonders for the company. We're talking a payback period in just several months. We're talking an IRR in the triple digits, above 500%. So stay tuned for the interview and you will get an exclusive insight into what lies ahead for Ramelius Resources in terms of the Crawford project, how it's doing for them operationally and financially, and what lies ahead in the short term and long term for stakeholders as well as the company alike. Please also note, just like every other video, that none of the content that we discuss in this video qualifies as financial advice, including the interview that we have with Mr. Daniel Tuffin, and that we recommend you seek a licensed expert if you're on the outlook for financial advice. And with that being said, let's jump straight into the video. Starting off with the movements in gold. So gold this week has ended at US dollars 3,651, which is a new record, and it's 1.58% higher than the previous week. However, Australian gold has managed to stay flat at Australian dollars 5,486 Australian dollars. The big picture for this week in terms of movements in gold is a weaker US labor data has raised the odds of a September rate cut. The dollar has softened. The CPI has also come in higher than expected just Thursday, which is yesterday, and gold raised after a short squaring off phase as investors anticipated the CPI results coming out on Thursday at 8 p.m. Eastern Time. However, movements in gold this week started in the New York afternoon on Friday after the August jobs report landed a mere 22,000 non-farm payrolls report with unemployment up to 4.3%. That stall speed print, alongside multi-month downward revisions, knocked the dollar off and firmed the market pricing for a cut next week, which is in the 16 to 17 September meeting, pushing spot to the cusp of $3,600 by the US close. And it did break the psychological 3,600 level with follow-through buying happening on Monday and set new fresh records, as we all know. At the same time, the US 10-year yield slipped and the front end eased as well. And by Tuesday, the rally extended as investors digested the government's indication that payrolls through March would also be revised markedly lower. Wednesday's macro catalyst, however, was disinflationary. The US's producers purchasing index came in negative 0.1% month on month, versus expectations for a rise, and treasury yields dipped yet again after a solid 10-year run, which was positive for gold as well. And finally on Thursday, the CPI price data increased to 2.9%. Traders had begun to square off their positions early Thursday just before the release of the data. However, gold prices shot back up again after the release of the CPI data, which, by the way, as we just mentioned, increased to 2.9%, and rising inflation increases the demand for gold as a store of value, and as a result of that, the prices did move forward to the 3,650 US dollars region. Now, at Gold Up Australia, we've got a future forecast to be flat at 2.9% in terms of the headline CPI for October as well as November 2025, and with a final drop expected to be in December at 2.7 or 2.8%. Once again. Moving on to silver. Silver followed suit with gold at US dollars 42.02, which is a 2.56% increase. So a higher increase than gold, but it's got the same macroeconomic catalyst pushing its price upward. However, it's important to know that the prices of silver rising or falling are also supported by supply and demand within the industry, as well as the industrial purposes or the use cases for silver, which are now quite important for the world as a whole, especially considering all the geopolitical uncertainties going on. Moving forward to crude oil, WTI crude oil closed at US $61.78, which is a 0.31% drop, whereas the gold oil ratio also dropped by 0.98 barrels an ounce to 57.30 barrels an ounce. Now, one of the biggest themes in recent oil market commentary is increasing supply. The IEA and other agencies have raised estimates for oil output growth both in OPEC Plus and outside that group. Also, OPEC Plus has been revising prior voluntary production cuts, meaning more barrels are flowing into the market, and US crude stockpiles have risen significantly, with reports showing a 3.9 million barrel increase in inventories in the week ending 5th September. That signals that demand is not absorbing supply as strongly as might have been hoped, and also refining inputs and exports haven't risen enough to offset the supply, which is causing a decrease in the current prices. However, some upward pressure arises from possible supply disruptions, which includes the drone attacks on the Russian refineries or threats related to sanctions, because such events tend to inject risk premiums to oil prices. For example, this week there was concern over geopolitical tensions after Poland shot down drones or pressures from the US sanctions or Russian export revisions. Because of these incidents, you may have noticed that the oil prices were actually on a high this week before they came down crashing to a low after the geopolitical uncertainties managed to consolidate fairly as we approach the end of the week. Talking about the ASX All Ordinaries Gold Index, it's not increased as much as it did last week to more than 900 points, but it has placed second compared to last week, as it is up 867.18 points to 14,696.8 points. Gold prices are an obvious contributor to this movement. However, other factors that is causing the ASX All Ordinaries Gold Index to shoot up suddenly and go on a rally is because the World Gold Council has been flagging persistent ETF inflows into bullion products into early September, which helps keep the global gold tape sticky at the highs and tends to lift global gold miners. At the same time, there's news for Australian miners. Australia's September S&P ASX index rebalance added Ramelius Resources and Genesis Minerals to the S&P ASX 100 index, and we've got many more additions to the other indices of Australia, like the S&P ASX 300, which is an index of the top 300 companies in Australia. And the additions that we've had from mining companies include Alkane Resources, Gretlin Resources, Black Cat Syndicate, Kingsgate Consolidated, and so many more. So this obviously is going to stir up a rally for the ASX All Ordinaries Gold Index. And if you carefully just inspect the graph for the ASX All Ordinaries Gold Index that we've got for you at Gold Hub, notice the sudden rally that's been happening in the last few weeks, or maybe the last 2 months. We've seen a very high spike, an upward spike, and we've got multiple factors at play, and we'd like you to watch the first 5 episodes to understand exactly what is going on, as Mr. Brian breaks it down very precisely for you viewers. Company level news helped too, and this is the company that we're going to be focusing on as a part of my commentary today, and that is Ramelius Resources. Ramelius Resources uploaded their Precious Metals Summit presentation on the 9th of September with outstanding FY25 results. On the financial side, FY25 marked a record year for Ramelius Resources with a production of above 300,000 ounces, which is the 5th consecutive year that Ramelius Resources meets both production and cost guidances, which is quite extraordinary considering that a lot of companies' stock prices tend to go up and down based on how well or poorly they do in context of the guidance that they've provided for the full year. And there's many a times that company stock prices go down simply because they haven't followed the guidance that they've provided for full year, or sometimes maybe even for quarters. So it's quite extraordinary that Ramelius Resources has marked this to be the 5th consecutive year where they met both production and cost guidances. Their revenue climbed 36% to Australian dollars 1.2 billion, and NPAT surged 119% to $472.8 million, while EBITDA margins expanded to an impressive 68%. These numbers show that Ramelius can consistently convert rising gold prices into outsized cash generation. reflected in the underlying free cash flow per ounce of 1,497 US dollars, which is well ahead of the ASX as well as their Toronto Stock Exchange peers. We'll insert a graph for you right here. And importantly, the company is also rewarding shareholders, lifting its FY25 dividend 60% to 8 cents a share and delivering a 3.2% yield, which is rare in a sector that is really focused on reinvestment. So not only have they provided really good standard of reinvestment opportunities for the investors who've been paid these 60% premium dividends of 8 cents a share, but they've also managed to have 29% of their free cash flow out as dividends, which is a record for, I think, any Australian company, especially in comparison to the peers of Ramelius Resources, not just in Australia, but also in Canada. Ramelius has also laid out an aspirational pathway to become a 500,000 ounce plus and per annum producer by FY30, which would elevate it into the top tier of Australian producers. And that pathway is grounded in cornerstone assets like Mount Magnet, a 17-year, 2.1 million ounce mine plan that was recently expanded by 37%, and the Rebecca Roe project, which boasts an after-tax NPV of 332 million Australian dollars at 3,500 Australian dollars an ounce, and is moving towards a DFS, which is a definitive feasibility study, in late 2025. The integration of Spartan Resources Dalgaranga adds another dimension. The Never Never and Pepper deposits, which is a part of Spartan Resources Dalgaranga project, which has been acquired by Ramelius Resources, are high-grade underground ore bodies, 2.3 million ounces at 9.3 grams per ton. Yes, ladies and gentlemen, this is probably the highest grade that we've mentioned as a part of the Australian Gold Weekly Review series so far. Prior to this, it was West African Resources about a year or two ago, which was producing their gold at 8 grams per ton. But the Never Never and Pepper mine of Spartan's Dalgaranga project is containing 2.3 million ounces at 9.3 grams per ton, which is an insane amount of gold to have per ton of ore that is mined by the company. The good news is Ramelius Resources has already finalized mine designs and secured approvals, with a pre-feasibility study narrowing processing scenarios to just 2 options, which is a huge de-risking and tangible progress on turning exploration success into operating cash flow. And the company has also announced an exploration budget of $80 million in FY26, with Dalgaranga's 6 kilometers long, mineralized corridor being the immediate focus of this exploration budget. And here, multiple drilling campaigns are planned to expand resources and find new ore bodies, while option value remains in assets like Edna May and Q, which can be scaled up as gold prices remain supportive. So let us know in the comment section what you think about Ramelius Resources as a company, especially considering that the outlook that they provided just 3 days ago on the ASX in the form of an announcement. Do you think they're overvalued? Do you think they're undervalued? Do you think they're fairly valued? Where do you stand? And please remember that none of the content that we've discussed so far in this video qualifies as financial advice. And that brings us to an end of my portion of the commentary. And what's coming up ahead is an exclusive interview with the CEO and the Executive Technical Director of Cavalier Resources, Mr. Daniel Tuffin. We're going to dive into the Crawford project, how the Crawford project has been doing operationally and financially for the company, what are the advantages, and if they go ahead with this project to stage 2, 3, and 4 mine pits, what is going to be the outlook for the company as well as the shareholders once that's achieved. You'll find all that in this interview, and please remember that none of the contents discussed in the interview also qualify as financial advice. And with that, thank you so much for watching, and let's jump straight into the interview. All right, good evening, ladies and gentlemen. Welcome back to the Australian Gold Weekly Review. For today, our guest is the Executive Technical Director and CEO of Cavalier Resources, Mr. Daniel Tuffin. How are you, Mr. Daniel?
I'm very well, thanks, Veed.
All right. First of all, congratulations on raising the $2.1 million placement in context of the Crawford Gold project, and we are very excited to see what lies ahead in context of the Crawford Gold project for Cavalier Resources.
No, thank you. Yeah, the placement was well oversubscribed, and we had it put away pretty quickly. Obviously, we'll talk a bit more about what it's for moving forward, but yeah, we're really excited.
Yeah, for sure. And we are too, because we see significant potential in the company, especially with regard to the Crawford Gold project and the other two projects that you have as well, which is the Gambia Lass North project and the Maletta Creek Nickel project. However, for today's interview, our focus is going to be on the Crawford Gold project and the placement that has been raised in context of the project. So starting off with the first question that we have is, could you start by walking us through what makes the Crawford Gold project unique compared to other gold projects in the Leonora region? And what do you see as the defining strengths that set it apart in terms of the geology, the cost structure, or the development pathway?
Yeah, okay, so let me give you a bit of an overview then. Thanks for that. So obviously you've mentioned it's in a tier one mining project area and jurisdiction in Leonora. The Crawford project lies about 20 kilometres to the east of Leonora, so it's quite accessible via road and a well-known hub in the area. So supplies, personnel, accommodation is pretty easy for us. What we've done as a company is focused on an area that's low cost, free dig, in that we've focused on the indicated portion of the resource that's oxide. In fact, 99.8% of the material contained in stage one is JORC classified indicated. And what that means for those that don't really understand is it's the highest confidence we can get before we're doing grade control drilling. We've focused on a starter pit. The resource is significantly larger than the current starter pit is, but the idea is to bring forward cash flows. So we want to look at having really good competitive mining costs. As a mining engineer, that's what I've been doing my whole life for others and myself privately as well. When I bring forward those mining costs, we'll have really low all-in sustaining costs. Our all-in sustaining cost for the starter pit is Australian 1574 C1, which puts us in the lowest quartile of costs for the project. And that's where you want to be when you're doing any sort of startup project. Obviously, the gold price has changed, but at about Australian 5,000 at the moment. Our MPV is 60 million at a 711% IRR. So again, ticking a lot of boxes there that we want to check off for a project startup. So we're also bringing forward gold production. So within about 3 or 4 months of starting production, we start to pour our first doré bars. And we are obviously in the processes of securing some sort of either forward prepayment or looking at other ways to fund the project. But Raptor Gold is that's leading the way at this stage.
Right. Thank you so much for that. With regard to the AISC, the cost structure of the startup pit at the moment, as well as the IRR, we've got a few questions lying ahead for that because we find it to be absolutely extraordinary. But the next question is that the company recently announced a $2.1 million placement, as we've discussed, at 23 cents a share.
Yes.
Can you explain for our viewers what the purpose is and how this sits with the impending funding package with Raptor LLC for US dollars 11 million?
I'll start with the last question first. So the two are mutually exclusive. The funding package does not impede upon the placement. There's no issues there whatsoever with Raptor at this stage. The use of funds for the placement is quite simple. We're looking to try and bring forward the extensional near mine development drilling at Crawford. So we want to get in front of stages 2 and 3. Mining at Crawford at this stage, we can really only talk about the starter pit, the stage 1 starter pit. But if you have a look at some of our releases, you'll see that there's inferred material to the northeast, plus a 500-metre extensional corridor, and there's indicated material to the south. So we want to just prove that up with this drilling and then start getting in front of, having stages 2, 3, 4.
Right.
If they're there, and they should be.
No, there should be, of course, for sure. We've got we've got magnificent news in terms of the stage 1 mine, and it lasts for 18 months. And despite that, we've got a payback period of 9 months only. We've got an IRR, your base case IRR of, I think, about 580%, which actually is considering a gold price of 4,600 Australian dollars. So we're sure there's even greater news ahead for you, and we do hope that this placement leads to further exploration around the stage 1 mine, and that you proceed with stages 2, 3, and 4.
Yeah, exactly. That's the plan. So the other things that we can discuss moving forward. You mentioned what the drilling might do um, elsewhere in that project, and we haven't really talked it up too much because we've been so focused on the shallow oxide material. But there's some fantastic grades at depth. They're sparse, but they're great grades in the fresh rock. And a lot of the times, the drill roll has ended in at the end of hole has ended in grades. So we now believe that this isn't a transported material from further up the road. We actually believe this is in situ. So being that it's a supergene, it's been weathered down from the fresh rock. Yilgarn Craton has about 1.5 kilometres on average been weathered down over hundreds of thousands of years. So it's a bit unique out where we are, and it looks like there's some great grades underneath there too. So yeah, we're again looking to really progress some of the hard rock targets as well out on site.
Absolutely. And we hope that you're able to achieve that and more. With the next question, so this is about the payback period and the internal rate of return that we were talking about slightly before. Now, with gold prices remaining historically strong, at least within the recent history, we've seen that gold has had quite a good bull run. Your PFS, which is the pre-feasibility study, suggests a low capital cost, a fast payback period, and an exceptional internal rate of return in the hundreds of percent. As I said, ladies and gentlemen, Ramelius Resources has estimated a base case gold price of 4,600 Australian dollars. The price of gold at the moment is well above 5,000 Australian dollars. So that's a pretty conservative base case to have. And despite that, they've got an internal rate of return of 580%. And considering all the capital expenditure, and despite all the capital expenditure, they've got a payback period of 9 months. So what are the aspects of Crawford that give Fort such attractive metrics despite having conservative assumptions?
Yeah, I mean, as I was saying, it's free dig, it's oxide only. We can heap leach the material. It's highly friable. It comes out of the gold drops into solution after about 7 to 10 days at about 90% recovery. So we've got cheap processing methods, got cheap mining methods. Because we don't have to drill and blast at this stage, it keeps all the operating costs down as well. And in the area, it sits in a graben near a freshwater sort of source. So our contaminants have been washed. So there's very little. The gold has been naturally leached over hundreds of thousands of years as well. So it's used to being leached anyway. We don't have to use a lot of lime. Our consumable costs are really low. So it's a bit of a unicorn. It ticks all the boxes. It's been sitting out there for about 20 or 25 years without anyone looking at it, mainly due to land farming. But we picked it up and put it into the IPO 3 years ago after doing some initial research on it and DD. And we've advanced this quite significantly far down the road with regards to approvals and funding in that period of time. So that's what really makes it sexy. We've got access to water and power if we require it, and we've got easy access to come in and out of Leonora as well.
Absolutely. So if I can just sum it up for our viewers, at this point, financially, what makes this project attractive in terms of its metrics, despite conservative assumptions, is the fact that you rely on heap leaching as a processing technique to get the gold. And that as a processing technique is relatively cheaper compared to the other methods, which does contribute hugely in terms of making this project a financial success. Is that right?
That's correct. It's infinitely cheaper. So as a bit of a background on myself as well, I started a mining consultancy based upon my production experience in the goldfields about 15 years ago now. So we do a lot of this work for a lot of other clients until I started taking up the mantle of technical directors in Cavalier. a CIL plant in Australia will cost about 100 to 120 million of about a 500,000 tonnes. For us to set up this heap leach pad to put through 1 million tonnes of ore and recover about 25,000 ounces, comparatively is about, I think it was $3 million. So our max drawdown is, including mining, is about 12 million at the moment, and that's one of the reasons why we can achieve such amazing return on investment and IRRs.
Absolutely. Moving on to the next question. You've mentioned that near mine drilling is a priority to extend Crawford's life beyond the startup pit, as we discussed. Could you share what exploration strategies or targets give you the most confidence that the project can grow beyond its initial stage?
Yeah. Firstly, we've got two areas that already exist within the current resource model. The area to the northeast is inferred, but it's got a decent amount of drilling in there. So that provides us with some confidence. And the area to the south, which is commensurate to the current size of stage one pit and contains indicated material, is already sitting there. It just needs some infill drilling. So we know we've probably got a secondary stage there. It's potential. I have to use that disclaimer at this point in time. But that's what we're looking to try and do, is prove up those particular areas. And that's what provides us confidence. And with regards to the Miranda area to the north, that extensional corridor that's about 500 metres long, drilling at the top end of Miranda on the hard rock target correlates with the underlying mag, the geophysics of what we think is happening there, where the control is, where the actual hard rock gold is sitting. Now that does have a sparsity of drilling. There's only about one line that goes right through the guts of the 500 metre corridor before you hit Miranda. So whilst we're not, I can't provide absolute confidence on the Miranda area, we do have portions of the resource that we just need to go in and either extend or do some near mine or infill drilling on to add to the project.
Right. Thank you so much. Thank you so much for that. And lastly, looking beyond Crawford, Cavalier Resources also has interests in other projects like Leonara, Hidden Jewel, and Ellis Rock. How do you see these fitting into the company's broader growth story over the next few years?
Yeah, so Cavalier's always been a bit of a unicorn itself, in that we set out when we floated the company a little over 3 years ago on the ASX to become a self-funded explorer, developer, producer, so that we didn't have to dilute too much. We'd have to go through the standard exploration cycle of raise, dilute, raise, dilute, raise, dilute. And so in that 3-year period, we've kept the register to, I think with this raise now, about 65 or 70 million shares. So it's really tight, and it's tightly held. Our top 20, actually our top 5 would hold nearly 50%. So that's the secret there, and that's what we wanted to do. Now, as to your question with regards to the projects, well, if we've self-funded ourselves and we've got gold project stages, multiple stages at Crawford, because it is a long 2 or 3 kilometre strike, we can then use that to develop up the other projects, more likely in the area Gandia Lass, and if nickel ever comes back, Melita Creek, which is 10 k's to the east on the nickel line next to Murrin, which is a well famous Glencore nickel producer in the area. Otherwise, we do have some earlier stage stuff, as you mentioned, down at Hidden Jewel, and that's closer to where I've had prior operations and worked at companies like Barrick at Paddington.
Right. Thank you so much. Thank you so much for that. So obviously there's a lot going on with Cavalier Resources, as you said. You've already got the stage 1 mining within production. I believe it's 29,300 ounces that could be produced from the stage 1 mine, if I'm correct. Added to that, you've also had displacement raised, which potentially allows you to or enables you to explore further and take the mine from stage 1 to stage 2, 3, 4, and added to that, you've also got some really exciting projects like Gambia Last North project and the Maleta Creek Nickel project as well. So, yep, there's a lot going on, and we do wish you all the best for that. And added to that, you've also got very supportive infrastructure. You've got the processing techniques that are the most beneficial for yourself as well as for the shareholders, I believe. And you've also got access to a lot of infrastructure that could support the operations at Cavalier Resources. And we wish you all the best for all the projects that you currently have and the ones that you acquire in the future as well.
Thank you very much. And just I'll leave off with, for any future potential investors coming in, the reason why we are keeping this tight is obviously when other companies have been in this similar situation, they've looked to issue dividends. So we're trying to come at it with a two-pronged strategy, which is defend and keep the gold price, the share price high. We want to keep that there, but also, issue dividends at some point potentially as payback. And if we start doing stages 2 and potentially stages 3 and 4, etc., it could be something that our viewers that have self-managed super fund, for example, would probably be interested in.
Right, absolutely. Thank you so much. Thank you so much for that. Thank you so much for the update, and we hope that all the listeners of this week's commentary had something to take away about Cavalier Resources, about the company, about its developments, and what's in store for the company as well as for the shareholders in the near future and the long term as well. So thank you so much, Mr. Tuffin, for joining us today. It was an absolute pleasure to have you for this week's commentary, and we wish you and Cavalier Resources the absolute best for the future ahead.